Over the past several weeks, three separate market developments have emerged in isolation. Taken individually, they look like isolated corporate headlines. Taken together, they point to a single structural mutation in global finance. It starts with the ultimate keepers of long term wealth, public pensions. Look at Pennsylvania's Public School Employees Pension Fund, PSERS. They manage roughly $85 billion for over 500,000 beneficiaries. Like many public systems, they are staring down a massive long-term funding gap, currently sitting around $41 billion. For years, institutional boards relied on private equity to juice returns and close these gaps. But the structural tailwinds behind that golden era have reversed. Recent state reports show PSERS private equity allocations targeted a 10.06% return, but delivered just 2.59%, the only asset class to miss its benchmark. And they aren't alone. From Alaska to Maine to Washington, major pensions are actively pulling back, but public liabilities don't disappear just because private equity underperforms. That capital has to migrate. It has to find yield somewhere else. Where is that capital going? It's flowing directly into a massive capital-intensive infrastructure race, the North American AI and hyperscaler data center buildout. Alternative asset managers are now scaling up loan origination to historic levels, targeting over $100 billion per quarter. To write checks at this scale, they've unlocked a massive permanent capital playbook. The integration of insurance general accounts. Instead of just managing external money, giants like Brookfield, Apollo, and KKR are actively building out multi-firm insurance platforms and dedicated reinsurance vehicles. They are absorbing massive entities like American Equity Investment Life, Argo, and American National to funnel predictable annuity premiums directly into their own private credit and infrastructure pipelines. The model is so efficient at matching long-dated liabilities with high-yielding infrastructure debt that even sovereign wealth funds are now bypassing traditional fund structures to co-invest directly alongside these insurance engines. Historically, insurance general accounts and sovereign capital were the most conservative pools of wealth on the planet. Today, they are the primary funding engines for highly complex, unproven AI physical infrastructure. This brings us to the third story, the unit economics of the technology giants absorbing this capital. Historically prized for being asset-light, high-margin cash cows, hyperscalers are locked in a capital expenditure cycle of unprecedented scale. Cumulative annual spending is projected to approach $700 to $800 billion, consuming the vast majority of operating cash flows. Free cash flow margins are tightening, forcing select giants into negative territory. To maintain the pace, they are tapping the debt markets, issuing an estimated $194 billion in AI-related bonds year to date. But public fixed income markets are beginning to show signs of stress. Look at SpaceX's recent $25 billion debut bond offering. While the deal drew massive initial orders, the secondary market reception was instantly rocky. Spreads on the longest-dated 2056 bonds widened by 28 basis points immediately after issuance, saddling institutional buyers with immediate paper losses. By early July, SpaceX's long-dated bonds traded at an average credit spread of 1.62 percentage points over treasuries. To put that in perspective, the average BBB investment grade spread sits at 0.92%, while the average BB junk bond spread is 1.55%. Despite carrying a solid BBB investment grade rating, the market is actively pricing this infrastructure debt wider than average junk bonds. The connection across all three stories is entirely structural. Pensions are locked into underperforming private equity portfolios. Insurance general accounts are stepping into the breach, funding massive tech infrastructure through affiliated private credit networks. And hyperscaler credit metrics are facing pressure as massive capital expenditure forces even investment-grade issuers to pay junk-level yields to clear debt. This entire loop relies on a singular assumption: that an immediate AI productivity boom will effortlessly double hyperscaler free cash flow within the next 3 to 4 years to service this debt. Apollo chief economist Torsten Slok notes that this assumption is exceptionally optimistic. As hyperscalers navigate aggressive GPU depreciation schedules and enterprise adoption faces longer execution timelines, a dangerous divergence is forming between front-loaded valuations and lagging cash flow realities. The systemic blind spot is detailed in a landmark Columbia Business School paper, Rating Without Market Discipline. Researchers found that privately rated corporate bonds, the exact assets filling these insurance and institutional portfolios, are twice as likely to impair as publicly rated bonds with the exact same rating designation, effectively masking underlying risk by up to 3.3 notches. When public BBB bonds start trading wider than high-yield indices, the market is signaling that nominal ratings are decoupling from economic reality. If the projected AI revenue payoff arrives late while interest rates remain structurally higher, the resulting squeeze will not be confined to the technology sector. It will expose profound correlation risks across the institutional balance sheets funding it. The historical precedent here is clear. Capital cycles always move faster than institutional risk models can adapt. When capital is abundant, structural vulnerabilities are easily absorbed. When cash flows tighten, those vulnerabilities become systemic. As we move through 2026, the critical metric to watch isn't tech company earnings, it's the underlying spread on infrastructure debt. If that spread continues to widen, it tells us that the market is repricing risk long before the rating agencies acknowledge it. On an interconnected ecosystem, the ultimate risk isn't that the technology fails. The risk is that the capital structure funding it runs out of time. If you like this content, please subscribe and hit the notification button and let me know your thoughts in the comments below. Thank you for watching.